The clouds of uncertainty parted last week as former President Donald Trump decisively won the U.S. election. Investors welcomed the news with renewed risk appetite, bidding the S&P 500 to its 50th record high of the year on Friday. Trump's proposed economic policies, including deregulation, a likely extension of the 2017 tax cuts, a possible corporate tax rate cut, and proposed tax exemptions on tips, Social Security, and overtime pay, helped underpin buyer enthusiasm. The immediate de-risking of when the election will be decided was another big factor behind the post-election day rally. Stocks were not the only asset class on the move last week, as Treasury yields and the dollar also advanced. Growth expectations re-rated higher as the market priced in more economic-friendly policy proposals. However, the improving growth outlook was accompanied by concerns over the deficit and rising inflation, especially with Trump's proposed tariff policies. Herein, we discuss these themes and other major election takeaways for investors. While we are only a few days removed from Election Day, we feel comfortable stating the bull market not only survived one of this year's biggest event risks, but thrived in the face of uncertainty. The S&P 500 rallied 2.5% on Wednesday, November 6th, with most of the buying done overnight as Trump tallied up electoral votes. By the opening bell, the index gapped higher by over 1% and didn't look back, closing at a fresh record high of 5,229 on Wednesday. This marked the best post-election day performance for the broader market on record. Positive performance after Election Day tends to be a good sign for future returns. Of the 9 other post-election day advances since 1928, the index gained 4.3% over the following month, with only one period producing a negative return. Longer-term, 3, 6, and 12-month returns averaged 6.8%, 8.5%, and 9.5% respectively. At the risk of throwing some rain on the post-election parade, we believe the enthusiasm for small-cap stocks may be getting somewhat overdone for 2 primary reasons. First, one key element of the small-cap trade is lower taxes under Trump 2.0. But given the federal budget situation, when the horse trading begins next year in Washington, D.C., we expect some pressure to keep the corporate rate where it is at 21%. Domestic production is another reason for the bullishness on small caps. Another element of the bull case is that smaller companies are more U.S. focused and less impacted by tariffs. That may be true, but for the profitable companies that make up the S&P Small Cap 600 index, we estimate that over 1/3 of profits are generated outside the U.S. For the rates markets, despite the recent run-up in Treasury yields, there is still room for yields to move higher, for both good and bad reasons. Since the recent lows back on September 16th, the 10-year Treasury yield is higher by nearly 0.70%. Markets are forward-looking and tend to adjust based upon expectations. However, given the unpredictable nature of economic data, consensus expectations may be wrong at times, which causes another market adjustment. Better economic growth data, perhaps a too-dovish Fed, and more policy details from the Trump administration could push Treasury yields higher. As Americans, politics are part of our DNA, and despite all our disagreements or the election outcome, we have moved forward with optimism and resilience since 1776. And while a Trump victory may or may not have been what you were hoping for, we can at least breathe a sigh of relief the election is over and embrace a world of no more political advertisements. For investors, policy does matter, especially when it relates to tax and trade. But as we have stressed, earnings, inflation, interest rates, and other macro forces are really the key drivers of longer-term performance.